For being around after the busy morning and the lunch. Topic of this panel discussion, Janet mentioned already, is how to get investor attention in the US and beyond. I think the existence of this conference is a clear proof and evidence that this topic is very, very interesting for many, very, very timely as well. Now, while nobody probably disagrees that it makes sense to think about investors abroad, I think it needs to be done in the right way. And therefore I'm very glad that we have such a diverse panel to talk about how it is done the right way. And with this I would like to start introducing quickly the panelists. I will start to my left, Professor Libbert, CEO of Biofrontera, founded the company in 1997. Next to him it's Gregor Cisentia. He's a founding member of Cisentia, Ross, Friedman, Ferencz, a securities lawyer. Then we have Adam Friedman, principal of Adam Friedman Associates, a communication specialist with 25 years and more experience. And Jennifer Simmons, one of my colleagues from Edison. She's looking after investor access, helping companies to access investors primarily in the US. And next to me, Thomas Stevens, corporate strategy and communications of Bank M, again with a long experience in capital markets transactions. With that, I would like to kick it off and ask the first question to Herman. Herman, you recently listed in London at the AIM market after being listed for a long time in Germany already. Would you please share your reasons for seeking the listing in London? And maybe on top of that, what is your overall strategy to attract investors internationally?
Yeah, in order to answer that, I should tell you a little bit about Biofrontera, what we do and where we actually stand, and then out of the position and the development status of the company, I can try to explain why we did the AIM listing and what our plans are. Biofrontera is, I feel a little strange because we are not from Bavaria. We are German, but not from Bavaria. We are from North Rhine-Westphalia. And probably the reason why we have been invited is that, at least to my knowledge, we are the only company that ever made it to a centralized drug approval in Europe with a drug that was entirely developed in-house. Only small company, of course. And so we are in dermatology, concentrating on skin cancer. Got a drug approved, centralized approved in Europe, which means that we can sell it throughout the entire European Union. And we have been through the normal stages of financing that every normal technology company goes through. Venture capital, public funding and all of this. And listed at the Frankfurt Stock Exchange in 2006, I think it was. And so at the Frankfurt Stock Exchange, we are by now in the prime standard. We always have been in the regulated market. And this has helped us enormously to finance the company to get where it is now, so go through approval. Most of our investors are small funds in Germany, Austria, and Switzerland. And I've been going to London relatively on a more or less regular basis since a couple of years. And London, out of Europe, London has the advantage that the density of institutional investors who are willing to invest into biotechnology is higher than anywhere else in Europe. Not as high as over here, but highest place in Europe, and I come to US later. So this is why London is clearly an interesting place to go to. And whenever I was there, I was told by London investors that they are interested in, they want to invest in their home market, the market they understand, and they want to invest in the currency they understand. That's important to them. I think there are some real reasons behind it, but there's also a lot of emotional reasons behind that are difficult to appreciate really. And but it's important to them. So if you really want to have investors from some place you have to have your shares trading on the local market. I think this holds true for London, and it also holds true for the US, at least for most companies. So now with London, we facilitated this by listing at the AIM, which is actually not a big thing for us because reporting duties are higher actually in Frankfurt. In the prime standard in Frankfurt, we do quarterly reporting. In AIM, we only do half-year reporting. So reporting duties are not an issue at all. So we don't have any extra expense because we are listed at the AIM, and that's why we just did it to facilitate approaching London investors. In the long run, but perhaps I can say that later, our plans towards the US and what we think.
Yeah.
Let somebody else talk first.
Thank you. With Jennifer, I found one comment from Herman interesting. He said companies for investors to invest, the stock needs to be trading in that currency. Now you take regularly companies from Europe to the US who may not be having an IDR listing here. What is your recommendation for these companies? How should they start communicating with investors? How should they start the process?
I think there's a couple different layers when you're starting an investor relations campaign in the US. I think you should start basically by making yourself as transparent as possible. A lot of US investors like to look around at companies, see their news flow, see if there's a PowerPoint presentation or an analyst report out. I think that also starting to develop relationships with analysts who cover international companies but have a good reputation in the US is very good. And then finally, I think that for non-US companies, it's very helpful if there's a certain type of hook. Maybe there's a major US investor. Maybe they have a big US partner. Maybe there's something that's important for the US that an investor can emotionally latch onto to develop a relationship with an international company. I also think it's very important to have somebody based here, work with an investor relations person or have a strong relationship with your analyst, because a lot of times people in the US will, they want to talk to a person in real time. So I think that those tools can be very, very helpful if you utilize them properly.
Yeah. Adam, you're a communication specialist.
Yes.
What points did Jennifer miss?
Well, I certainly would agree with what Jennifer said. I might add to that things like, for example, a website, which is a really robust website, which many of these companies don't have, and may not even be in English. That's critical for a company that wants to come to the U.S. and find U.S. investors. Certainly having an address here, whether it's an IR firm or an individual, that's critical as well. Certainly transparency is important, and one of the issues is reporting. As you know, you can report semi-annually in Germany, but we're used to in the U.S. to quarterly reports, and that's an issue. And because if you want to track, you want U.S. investors to track your company and its performance, then they want to do it quarterly and not semi-annually. And they do want the kind of information that would be typically available for a U.S. company. Then there's the question of whether or not an ADR is important or not, and I think there's a lot of people that come down on both sides of that issue. Certainly an ADR is a good thing and a positive thing to do for German companies if they're coming to the U.S. It's not necessarily critical, but again, it enhances the availability of the purchase of the stock, and that's important as well. So a combination of all these things are important to make it look like more and feel like more of a U.S. company and not just a German company. The final thing I would add to that is finding, if you will, peers, that is U.S. peers that are similar to that kind of the company that you're bringing over. So if you're in the biotech sector, or if you're in high tech, or whatever the area might be, to establish and make people understand that you're not a one-off kind of company, but you're similar to companies in the U.S., you're part of the peer group, that makes them be able to compare performance, technology, and so on with those companies, and that helps again to transparency.
Thomas, I know that you're doing with some of your clients, you're doing some little bit maybe less mainstream events to bring them closer to foreign investors. Maybe you can elaborate a bit on that side as well.
And maybe that adds a little bit to what you said. We also think that reliability is something. You cannot come once and then it takes another year till you show up again. You have to consistently communicate to the investors. A relationship has to develop, and this can be, or of course it's much more challenging to develop a relationship if you're talking between two different cultures. Our direction is a little bit different. We take companies from all over the world onto the German stock exchange. Most of our clients are German companies with German investors, so that's easy. But then we have a lot of companies who, for whatever reason, want to be listed in Germany, but they come from a different cultural background, from Asia or from the US. And then you have to really create trust. You have to come over and over again. And one idea that has worked pretty well for us is that we take the investors to the facilities of the country itself and in the country of the company, and show them the company, show them the main production facilities, and also spend time on the premises with the CEO or the founders of the company, and start the process from there.
To you. 2 weeks ago, I was sitting with the CFO of a listed company in Germany. We were talking about investor access. He said, I like to go to Switzerland, I like to go to London. I'm not very keen to go to the US. That's much too risky. What do you say to that?
What do I say to that? I think for a company to raise money, there's no place better than the United States. And for U.S. investors to be interested in foreign companies, I think getting to what was said earlier, you need to be a reporting company here in the United States, and that's the transparency that investors are looking for. I think it's very hard for companies to find U.S. investment unless they're fully reporting here, filing registration statements here. Even as a foreign private issuer, if they're going to issue ADRs here, I think that certainly adds a level of confidence. But I think it's very hard to get U.S. investors interested in foreign companies that don't trade here. I think the interest is much less. And getting back to your question, it's individual preference. I don't know what the risk is of raising money where the money is. I mean, the money's here. Why don't you come here? I think it sounds a little naive to think you're going to do better in Switzerland. But again, everyone has their own preferences for whatever reason. I don't really understand the basis of that comment.
So what are the biggest legal risks or pitfalls investors have to, or companies have to watch out for?
Well, it's not really a legal risk. I mean, there's a cost. I mean, you guys already pay for your audit, so the cost is going to be minimalized trading here. There's going to be there's going to be more attention paid to the stock. I guess there's always a risk that your stock trades down, that there's more selling than buying. I guess that's always the biggest risk, which certainly can be mitigated through investor relations and communicating with your shareholders. But if you really want to raise money, here's the only place to go. I mean, this is where all the biotechs come to raise money. There is the AIM, but there's not a lot of volume there, I would think, on the AIM. I mean, traditionally, there's not been a lot of volume. The volume's here, the investor activity's here in the United States. So, I mean, the risk is that, you don't do a good job communicating with your shareholders, and there's more sellers than buyers, and your stock goes down. That's the big risk.
I would like to add a little bit on this, or maybe even a little bit disagree. I mean, first of all, we have in many European companies, we have a lot of American investors who are not trading in the US. So you can go to all the company files, look at the investors, and of course, in the US you have many investors. You also have many investors who specialize on investments in non-US domiciled or trading companies. So this is one thing we see a lot. So it does make sense as a German company also to come to the US. And of course, there's also a lot of specialized European investors. I think for life science right now and the big internet plays, the US is definitely the place to be. The valuations are extremely high. Nobody can compete right now with those valuations globally. But if you're looking for a stable investor base who also looks into cash flows, who looks into technology, who looks into a long-term perspective of a business, Europe is not a bad place to find investors for.
There's just not enough, you know, I mean, that's what, you know, there's just not enough of an investor base there. And if you really want to raise serious cash, I mean, of course there's investors all over the world, but, you know, what's driving this market right now is technology and biotechnology. You know, that's what's driving the market. So, I mean, we don't find a lot of companies seeking investment overseas. We find a lot of overseas companies looking for investment here. You know, the couple of hundred public companies we represent, you know, we're taking companies from all over the world and listing them here because they're seeking money. They're not chasing the dollar like everyone else.
It's definitely true that the US is currently the most attractive equity market. I would completely agree on that. What I don't agree is that it doesn't make sense to have a stable investor base with investors from all over the world and also diversify. If we looked at the States, especially in biotech, about 7 or 8 years ago, we did some roadshows with German biotech companies, and we had almost crying investors. The US is riding the wave extremely strong, but when it goes down also extremely strong. So it always makes sense to diversify, to have different types of investors, and to serve those different investor types in their markets with their individual needs. This is at least our point of view.
I would maybe at this point I would come back to Hermann, and if we say US, I mean I think everybody agrees that US is an important market. The question is it the only one? What's the relative importance of it? But I mean, having this in mind, Hermann, what's your strategy for US investors? Is it you just listed in AIM? Is US at some point, or how do you approach the US? What's your view on the importance of the US as capital market?
Well, I agree basically with everything that was said. And I really believe it depends on the stage of your company that you are in. I tend to believe that if you want to come here and get money, and investors think that you are here because you can't get that money at home, in your home market, then you won't get it. You can only come here. I think if two things are true. One is you can get your money at home just as well, and you are here because you want to have access to a much larger market for your future growth, because you want to have access to a more lively market with perhaps more trading, more liquidity in your stock. All of these things that you find here that you, and I agree with you, you'll find nowhere else in Europe, or nowhere in Europe. But if you can't do it in Europe, at least at the extent that you need, at a smaller company, you won't be successful. And the other thing is, I think in the long run, US investors want to see business in the US. They want to see the company be active in the US. And for us, we are now heading towards getting our drug approved with the FDA. And that's basically for us the point in time to start talking to US investors. And along with the FDA approval, we think we can also be much more active on the US market, and everybody will understand why we are here and why we also need the money and why we want to expand the company way above the level that the company is now. So all these questions won't be raised. And then I fully agree with everything what you have said. But before you are at that level, I don't think the company is ready to make use of the US stock market.
So you would argue that to a degree the business operations and the capital markets presence go hand in hand. So you internationalize your business and you return it. It's an interesting point. Jennifer, what are your views? At what point in the life cycle of the company should they think about reaching out to the US or any international market?
I think it really depends on the industry. One thing that I've noticed, the companies that have the most success are ones that if they're not US based, they're international, if they have a little bit more of a cutting edge or a little bit more of an advantage or a really great shareholder, you need something that gives a company a little bit more of the halo effect. For example, one time I worked with an oil and gas company that was based out of Sydney, Australia, but they had a large investment from the Quantum Soros group. So to have that seal of approval gave a lot of confidence to US investors. I think that also, I worked with another company that was a satellite company. It was backed by Paul Allen, and they had a relationship with Lockheed Martin. So your partners, your relationships, or if just your technology or your business model is that much more kind of superior to US comps, I think that that gives you a tremendous advantage.
I would add to that, if I may, that I think that it will vary for every company in terms of when they want to access the U.S. market. But very often, I think the IPO stage is where you want to be. I mean, IPOs, let's take it in Germany. How many IPOs were there in Germany last year? I think you can count them on two hands. Whereas in the United States, there's been multiples of that. And that bespeaks of access and also risk. The risk profile here of investors, we have a greater tolerance for risk. In Germany, we know investors are risk averse and tend to go to fixed income as opposed to equities. So I think it really is a considered decision, but an important one to think when a company in Europe does an IPO, if they shouldn't do it here as opposed to their home country, because if you launch here as an IPO, one, you've got liquidity, and certainly an opportunity to have greater liquidity, and greater valuation. Whereas, and just statistics, if you look at the German Börse, just did some analysis, and since 2007 and 2013, first of all, the amount of US investors in the equity market in Germany is about flat. Nothing that really has changed. Now, of course, we had the recession in between, and that had an impact. But the fact is there isn't been significant growth. If you look at PEs, you're looking at a 28 PE in the US versus about 12 in Germany. So that says to any company that wants to go public, well, I got to examine that. That certainly should be an option to be considered up front. If they're ready IPO, they should certainly be considering it, because there's always going to be a secondary, and any company that in that sector, or technology, or IT, or biotech, etc., has an incredible appetite for money, and the place to get it, as Greg said, is here.
Right now in Germany, cash flow companies that want to extend their business operations internationally, which a lot of German companies do very successfully, and they get money from the banks at 1%, 1.5%. So the financing situation in Germany is very, very positive for successful companies. The same type of companies investors would like to invest in. So the investors are actually there, and if you talk about the valuations, maybe Germany is an interesting market to look into if you have similar companies trading at a PE of 12 compared to 24. Maybe it's just a market in a different cycle, and it's a market investors should look into.
Yes, I can say something to that. I think the German market is a good place to be if you are cash flow positive. And out of that situation you expand perhaps globally. Then you may also get money from the banks. As long as you're cash flow negative, you definitely won't get a single euro from any German bank. And when you talk to German funds, when I look at fund managers in Germany, Switzerland, Austria, then in London, and then in New York, then there are very, very few small cap funds in Germany. And the fund managers are usually, or always, really generalists. So they talk to biotech companies, oil and gas was mentioned, and everything else. And they know everything. They can't see any further than 2 years down the road. When you go to England, they are a little more specialized. When you come here, they are industry experts. Nobody would look at a biotech company who doesn't have experience in pharma and biotech. And they can look much further down the road, and they understand what's going to happen in 5 and in 10 years with that company. And they also see the growth opportunities much better because of their professional background. And that, I think, is the difference. And when you are ready, when your company is ready to make use of convincing your investors that 10 years down the road, if you only get enough money, which you can find here, 10 years down the road, you can really grow that money, then I think you're much better up here. So I would definitely agree with these two gentlemen.
I think these markets also create a liquidity event for some of the founders of the company or significant shareholders, where there's a ready market. They can cash out of some of their, there's a liquidity event. There's a succession plan built into these markets that you're not going to find in private markets, just going to the bank and borrowing money for growth. That's not always the whole story. There's a lot of money to be made here, billions and billions of dollars, and the multiples in these markets are just incredible, right? They're unparalleled. So I don't think you can compare the equity markets here to the banking markets in Germany or in Europe.
I mean, I think it's clear, Adam, you and Gregory are big proponents of the US capital market. So I would like to ask you, are there actually company sectors where it doesn't make sense to come here, international companies? It does. Are there certain sectors that
I think, especially biotech and technology.
Where it doesn't make sense.
Where it does not.
Yes.
We're cyclical, like everything else. Biotech is red hot right now in the United States, as is technology and defense. Right now, maybe minerals and minings. Iron is sexy here right now. I think it's gonna be harder for international companies to find traction. The energy market's down. Rare earths is hot, because there's a defense aspect of that. But there are certain industry segments that aren't exciting here at the moment. They might be exciting tomorrow. They might have been exciting yesterday. It always comes back, So, for the moment, there are always going to be companies that are industries that are out of favor. But for the most part, eventually they'll be in favor. So there's always going to be a time for it.
Adam, from your point of view, are there companies shouldn't come to the US?
Well, I think a company, for example, that is sort of a basic manufacturing, or things that are I hate to use the word, but are not particularly sexy, or don't have, to use Jennifer's word, the halo effect, if you will, I don't think I would bother. I think it's just too hard, because you're going to have to climb uphill. And you want to go, like in every other investment thesis, where there's excitement and interest, and where the pools of money are investing. And they're not investing in things like I find basic manufacturing, and energy is another one right now, although I think that's going to change because that's very cyclical. So I think you want to stick with the hot sectors, and that's where you go with that. And then you bide your time and wait, because there are always, the beauty of the U.S. market is that it's so vast, and there's so much capital here, and you can access it, but it gets harder to access if you're not in a sector that's on the rise, but it's frankly hot. And therefore, if I had a client that came to me in those non-hot, so to speak, sectors, I would say now is not the best time. You should probably wait.
I think the only caveat to that in manufacturing was China, where the manufacturing margins were so great, they could produce for pennies and sell here, that we were jumping all over anything. 5 years ago, when China was more in favor, we were jumping on anything Chinese manufacturing because they paid 50 cents an hour for labor, right? And that's changed too.
Right.
So now we moved away from China.
I think that also looking at the shareholder base is very important. Sometimes if you have an international company and it's all retail and mom and pop shareholders, and they come over to the US, it's not going to have the same strength as if you have a really strong institution behind it. So I think that whenever you work with a company, you have to not only look at the company, but also who is composed of the shareholder roster. I know that if you have a large institution or a firm one, then it gives a little bit more of a seal of approval for coming over here.
So even if it's a domestic shareholder base, which is institutional, you say?
Yeah.
So, okay, so it's a business halo effect,
Yeah.
but it's a shareholder.
It has to, it has to kind of come out, people have to recognize it as a name brand.
It's interesting. Thomas?
Yeah, at this point, I really do have to agree this time. This is why we like the American market, because it's so differentiated. It's really huge, and you find investors for many, many companies. You just have to look carefully. You have to build a relationship. So, and this is the U.S. markets, and we are actually The Asian market is also, as an investment market, extremely big, but completely non-differentiated. And they're almost only excited about IPOs, and they have, to my point of view, long-term very unrealistic expectation on the return. So it's a huge market, but the differentiation you have in the US market is, and in London to some extent, is unparalleled. So if you just start building those relationships, you continuously work at it, you have a very good chance to find your right investor base in the US. And that is a fully agreed on.
I would like to turn it now around and look at German investors. What is from your experience, what does it take for international companies to attract interest in foreign companies' interest in Germany?
European investors, basically, in general, all the same things apply, because it's the investor he wants to be safe, and he wants. But there's a couple of things that in Germany you don't have this investor base who's made this experience of tenfolding their investments by investing early into some internet game. So the logic is, I do 10 investments, and in one investment I tenfold, and then it almost doesn't matter what the other ones do, so I take that risk. This is an experience a lot of German, European investors haven't had, because they just haven't had the chance to invest early in Google, or so they are typically a lot more conservative. They really look at a share as a financial instrument. So they ask, what's dividend yield, what's the differentiation to the competitors, how is the quality of the management, and this plays a much bigger role than saying, okay, this might be the next huge thing where I can tenfold my money. So this is, if you want to put it in a nutshell, this is a little bit of the core of the issue. And this is why people also, European investors, if they look at the valuations that are happening right now in the US, that is difficult for them to digest. How is a company, this investor thinking, if I look how the company, how many years of dividends they have to pay me in order to pay back that valuation which I'm paying them today, how will that work out? So it is in that sense, it is a different type of thing.
Adam, you work with Deutsche Börse. What do you think, what keeps, from your experience in general, what keeps US investors from investing in Germany? And Gregor, you made the point in the beginning as well that there's little interest from the US investing in Germany. But Adam, maybe you start. What keeps them?
Well, it's clear that there's a real, as US investors perceive, obstacles to investing in Deutsche Börse companies. And the Deutsche Börse, to their credit, are beginning to look at that seriously and saying, we need to do something to make this a more, if you will, investor-friendly market. And so clearly, some of the things we mentioned before, the valuations are much lower. The liquidity is a real issue, because as you know, the US investors, unlike, not really retail, we're talking about institutional, and they can't look at a stock that has no liquidity. It makes no sense for them. So those are issues. There's also a problem because what the German Börse wants to focus on, I mean, they got the Siemens and BMW and whatever, and those kind of companies, that's not their issue. What they want to focus on is get more high growth companies, whether in IT or in tech or biotech or what have you, to list on the German Börse, but they're not coming there because they're not getting that kind of valuation, and it's a little bit of a chicken and egg. You don't get the valuation, you don't get the investors, and U.S. investors are very, very specific. They know exactly what they want, and they have, when we meet with U.S. investors, as we did very recently, we were talking about that earlier, they have very specific criteria, and if a market like the German Börse doesn't meet it, they just pass because there are too many other opportunities. You may remember, I think it was about 7 or 8 years ago, the German Börse created the Neue market. Well, that was a disaster. It just never took off. And they've, in a way, never recovered from that. because the perception is they don't really address, like the AIM, for example, more of those kinds of companies. So these are issues that are part of it perception, but part of it reality. To the credit, as I said, the German Börse is now looking to make some in what I would call IPO's list, in making it easier, in creating more liquidity and so forth. What they will ultimately do, I cannot say, but they are at least seriously looking at making what I would call very important changes that would change its attraction to U.S. investors.
I think another thing a lot of these companies could do is to consider listing here as well as on the German exchange, and I think that would solve a lot of their issues. U.S. investors want to see U.S. listings, and that's what they're comfortable. They're comfortable reading SEC reports rather than trying to go search out reports from different exchanges. And I think if a lot of these companies could be convinced to list ADRs here, or even list their lowest level of ADRs here, I think they'd find a lot more success in attracting American investors. Because sometimes American investors will invest in anything. Just show it to them and they'll do it. But you got to show it.
Look, I mean, a little bit counter to that. I mean, we had, like in the past, we had a number of German companies having a full, proper secondary listing in the US. And most of them actually withdrew the listing.
Oh, they did.
So it's not ADRs, but it was like
their common stock.
Yeah. Would you think this has changed, or is like you just need an ADR, which is easier, or what's your view on that?
Well, I think it's preferable to list their common stock if they could. But we work right now with a lot of Israeli biotech companies who are listing here, 3 or 4 of them. And they've all listed their ADRs here because their primary security trades on the Tel Aviv Stock Exchange. But they have found that, they're here in the United States a lot, they're attending conferences, they're getting in front of investors, they're going on roadshows, and their ADRs trade very well here. But again, it's a hot market, it's a particular sector, the biotech sector. So the ADRs have been successful because, and I think in part because the market is so good right now. But I think if you had a choice and you can list your primary security here, I think that would be even more attractive to U.S. investors.
I think for a number of companies, it's simply too much work, too much cost involved in doing proper listing. So maybe moving it back to the practical steps of being listed in Europe, but looking to meet investors in the US. Jennifer, from your experience, I mean, how often should they come? I mean, it's costless. I mean, how should they do the ongoing program?
I think that one of the things that's very helpful for companies is if you're in a certain industry, find out an event or a conference or a trade show that is going to be in one of the major investment cities. For example, in the oil and gas sector, there's the IPAA conference, and that attracts a lot of investors from Texas, from California, from Denver. So, and it's also very oil and gas. Everyone has that on their mind because it's a conference specifically dedicated to that industry. So I think that probably having that as like your base for a roadshow is very good, and you can do that annually and give investors updates. Another thing is just maybe do it maybe 6 months later. But another thing is it also depends on the industry. In oil and gas, it can take 6 months to drill a well. In healthcare, events can happen a little bit faster. So I think it depends on how fast the metabolism is of the industry. But I would say in general, once to twice a year. But also keep your investors updated through press releases and reports and updated presentations.
Thomas, you have ideas? We would add something?
We actually tell our clients to be in the other country at least 3 to 4 times. Also, go to the conferences, of course, but we think at least to offer a contact 3 to 4 times a year is better than only to do it once or twice. Because if somebody doesn't have time at that one point in time, then it's already only 1 contact per year. So we would really advise to do it more like 4 times every year. That's just airplane ticket away, usually. Good.
Beautiful.
Actually, I would like to open it up for questions now. If anyone has a question for the panelists. No question, please.
I guess if I would add something to your point, as someone who deals with investors, the ADR is perfectly fine.
It is. It trades. You know, it's all done through Bank of New York or Citibank. So you have all the disclosure. You have all the disclosure and all the transparency that you would have in an ordinary share or a common stock. I would agree with you.
And I'd like to find some of those investors that will invest in anything.
Yeah, they're out there. They're out there. Usually mostly doctors.
Just like her.
Well, maybe I should end with another question about you. Oh. Sorry.
Yes, actually, we've been talking about investments just into specific firms, but what about LPs for funds? Do you see any potential there, like cross-Atlantic? Specifically, like, would it be possible legally and also factually for like American LPs to invest in a European venture fund, for example? How would you go about that?
How would what? Excuse me?
How would you go about that?
How would a European?
Like, would it be possible that an American investor invests in a European VC fund?
You have to do what every other company does and get out and hit the road and show them why your fund is returns are better than, you know, investing in a U.S. fund. I mean, there are people who are out there who just market funds for a living, and it's very competitive to find a fund of funds to invest in you, and you have to go out and show them that your returns are going to be better than the alternative. You know, you have to compete for a dollar just like every company does. It's not easy.
Well, I think you have to think in terms of, I think we're all saying in many ways the same thing. This is a marketing effort. This is not, and it's marketing and it's sales, and it doesn't stop. If you're going out there and you want investors, particularly U.S. investors, it's an ongoing thing. Your investor base will undoubtedly change, and it changes sometimes more frequently than you would like. But it just means you have to continuously go out there and solicit investors, whether it's mostly institutional, sometimes retail, whatever it might be. But because the market is so frothy and the market is so large, so you're always in competition, and the competition is fierce, and everybody's jockeying for those dollars, and therefore that the sophistication of your marketing effort is critical. And I think that's what investor relations is all about. One of the things, for example, we didn't address here, if I may, is media. One of the things is visibility. Well, it's critical to, if you're in IT, you're in a biotech or whatever, there are vertical books, and of course, when I say books, I mean that loosely, but online and blogs today and all kinds of social media that are addressing that particular vertical market. You have to go out there and get visibility, and you solicit that visibility. It doesn't necessarily come to you. And that's an important part of the whole marketing effort, what we call investor relations. Important to remember.
If there are no questions, maybe I would quickly ask each of the panelists to give a very quick outlook. Are there certain trends that they believe will change? If there anything, is it just going on like the markets are getting more and more international? If you just spend maybe very quick your thoughts on where are we heading?
So if you want me to start, I think the money goes where the money is. And for good reasons, because you have to have as an investor, you have to have the liquidity. And this is why I'm afraid that the most active market will stay where it is now, which is in here, basically. And for a company to make use of that, there's one aspect that hasn't been touched, I think, which is a very important aspect, and that is, well, the word was mentioned twice, is liquidity. If you list your shares here, and you come here, and the number of shares you have in your hand to sell is worth, I don't know, a couple $1 million, this doesn't create the liquidity that your stock needs to be successfully traded here, and that can successfully grow here. You have to have a major event somehow with a reasonable amount of money behind your shares that you at the time where you come here. And that's also brings me back to the stage of your company, as to where is the company, when do you need that amount of money, and what do you want to do with it? And if you can answer these questions in a way that investors are happy with it, or if you can show them that this is going to happen in a year's time or in 2 years' time, such that they believe it, then you're ready to come here. If you're not there, then you're not yet ready. And I think the companies you mentioned before with the double listing, they were pure German companies. They had a double listing between Frankfurt and New York, and it didn't work because they couldn't create any liquidity here. And these companies were just not ready. And there are very few examples where this was in fact successful, and those were companies that were just a little more advanced.
If you ask where I think the market is going, I think it is changing. Unfortunately, I think the biotech market that window is getting tighter. You know, we're in the midst of many different biotech transactions that we've postponed or delayed because of market conditions currently, and that's a new phenomenon. We definitely see some more interest in technology and telecommunications, homeland security, things like that. I mean, biotech is still there and it's hot, but it's not as hot as it was 12 months ago, or even 6 months ago. So, there's been a great run there, and I think that might be cooling off some, and other industries are becoming, attractive to investors as maybe in place of biotech to some, unfortunately, to some degree. That window may be closing a little bit. So that's what we're looking at now is technology, transportation, infrastructure, things like that.
I would conclude by saying I think it's obvious here that clearly the markets are going global. There's a globalization of the markets, and it's particularly true in the U.S. More and more companies are coming in. It doesn't matter from where. They're coming from everywhere. And what we didn't mention is, remember, there's always political risk. For example, we have some Russian companies that are listed on the LSE, but there's issues now, and whenever we start a meeting, the first question is, okay, what about Putin and the Crimea, and et cetera, all the obvious questions. So it becomes 20 minutes of a political discussion, which has nothing to do with the business of the company. So there's political risk in some cases, there's currency risk, which is another factor that has to be taken into the mix. But I don't think that, or any of the things we talked about, is going to change that huge trend and that cascade of companies coming to this market. And the issue is, if you're a company, whether German or Europe, whatever, that wants capital, that needs capital, that wants all the attributes of a very successful public company, you need to have a presence in this market.
One trend that I've been noticing more and more over the past couple months is a lot of investors, and maybe it's just my group of investors, they like companies that have revenues, and they like companies that are already in motion, not a dream and a business plan. They want something that's very tangible, where there's sales, where there's product, where there's a market, where there's buyers.
That's been a long trend.
Yeah.
No, I think it's very hard to foresee what's going to be in the future tomorrow. I think we realize that the stability there is no real stability. Tomorrow is always open, the future is bright open, things can change rapidly. Markets can change dramatically in a very short period of time. I think what's strong and what really helps companies in those changing markets is to have a diversified investor basis. Markets also the US can change dramatically. People who invest with money that's not their own, who invest with other people's money, that behavior can change dramatically overnight. There's other people who invest their own money, they tend to be a lot more stable. And I think what's really important in those times where things can change rapidly is to have those good, lasting, trustful relationships you can build now up in this market. So you have to have a direct contact to your investors. You have to talk to them truthfully, which is very important. It's always easy to give the good news, But to talk about the bad news, this is what creates that level of trust. And those are those relationships you need if you want to develop your company in the long run and make it a little bit less dependent on the ever-changing markets.
Good. Well, thank you very much. Would you join me in thanking all our panelists for the